Welcome to the Deep Dive. Today we're unpacking the latest from Walmart, their first quarter fiscal year 2026 earnings call.
That's right. We're going to break down the key results, get a handle on how management sees things, especially, the whole tariff situation and what it means for the business, all based just on what they said on the call.
Exactly. The aim is to get you up to speed quickly and thoroughly on their performance and what they're signaling for the future.
Right. So let's jump in. High level Q1 results.
Okay, consolidated sales were up 4%, constant currency.
And constant currency just means taking out the effects of exchange rate swings. Yeah. Gives you a clearer picture of the actual business growth. Profit grew 3%, same basis.
International did well, up 7.8%. Sam's Club U.S. comparable sales, if you exclude fuel, rose a solid 6.7%.
And Walmart U.S.?
Comparable sales there were up 4.5%.
And e-commerce was a big story, wasn't it?
Definitely. Global e-commerce grew 22%. And the interesting thing is, every segment, U.S., international, Sam's hit at least 20% growth online.
Wow, okay. And inventory?
They said it's in good shape, up about 3.8%. Management called it a good first quarter. Sales were basically as expected, but profit actually came in better than they thought.
And crucially, they pointed out the sales growth came from more transactions, more units sold, not just higher prices from inflation.
Right, people actually buying more items more often. Okay, so let's dig a bit deeper into what drove those numbers and the outlook. Walmart U.S. first, that 4.5% comp growth.
Yeah, and you mentioned the e-commerce boost there, 21% growth. That certainly helped.
Looking at categories, grocery was strong again, mid-single-digit comp growth, and they actually gained some market share.
Health and wellness too, right?
Yep, high teens growth there, mostly higher prescription volumes and over-the-counter stuff.
But general merchandise was a bit softer.
A slight decline, yeah. Things like electronics, home, sporting goods were down a bit.
Okay, how about international? That's 7.8% growth.
Strong performance in China and from Flipkart was a big part of that. And again, double-digit e-commerce growth across the board internationally, mostly pickup and delivery and marketplace sales.
They mentioned Mexico being a little weak earlier in the quarter.
Yeah, a combination of, the general economy there, comparing against last year's stimulus and Easter shifting, but they did say it picked up more recently.
Got it. And Sam's Club US, nearly 7% comp growth ex-fuel.
That was really driven by transaction growth. And their private brand, Members Mark, apparently did really well.
And the digital angle at Sam's.
That really stood out. Over half their members now transact digitally in some way. And Scan and Go usage that jumped 600 basis points in penetration.
So members are definitely liking the convenience there. Okay, now this seems like a big one. E-commerce profitability.
Yeah, they hit a major milestone. First time in Q1 achieving global and Walmart U.S. e-commerce profitability.
Wow, okay, how did they manage that? It's been a tough nut to crack for a lot of retailers.
Well, management pointed to a few things. One is just scale, getting more density in their delivery network, spreading those costs over more orders, more households.
Makes sense. Lower cost per delivery.
Right. They said unit delivery cost came down thanks to supply chain improvements and, interestingly, customers being more willing to pay for faster delivery.
So a mix shift helps too, towards higher margin things.
Exactly. Growth in advertising and membership, those higher margin businesses, are really helping the overall e-commerce profit picture now.
International e-com was still slightly negative, though.
Slightly, yeah. But overall, the whole enterprise e-commerce operation was profitable for the quarter.
And they're getting faster, too.
Definitely. U.S. sub-3-hour deliveries were up 91% compared to last year's Q1.
And internationally?
Same, or next-day deliveries up 35% internationally. And get this, at Walmart Mexico, 45% of those were done in under 3 hours. Speed is clearly a focus.
Okay, let's talk more about those higher margin businesses helping the profit story. Advertising and membership.
Both very strong. Advertising revenue grew 50% across all their markets. Now, that includes the Vizio acquisition impact.
Right. What about just the core Walmart ad business?
Walmart Connect in the U.S., excluding Vizio, was still up a very healthy 31%. Sam's Club U.S. ads up 21%, international ads up 20%, led by Flipkart.
And that's coming from marketplace sellers and their traditional suppliers.
Yep, both. And the membership fees up nearly 15% across the company.
Sam's Club US saw steady growth. Member counts, renewals.
Yeah, member counts up, renewal rates solid, plus member penetration growing. Sam's U.S. membership income grew 9.6%.
And Walmart Plus.
Double-digit income growth there. And Sam's Club China membership income was up over 40%.
So these are becoming really significant income streams, not just side businesses, helping the overall model.
Absolutely. Okay, shifting to margins. Consolidated gross margin was up slightly, 12 basis points.
So just over 0.1% improvement, helped by the U.S. business.
Yeah, helped for Walmart U.S., but offset a bit by mixed pressure internationally. Walmart U.S. gross margin specifically was up 25 basis points.
And why was that?
They credited disciplined inventory management, meaning fewer markdowns, and that better business mix we talked about, which offset some pressure from the mix of merchandise categories themselves.
Okay. What about costs? SG&A, selling, general, and admin expenses.
They deleveraged slightly by 6 basis points, meaning costs grew a tiny bit faster than sales.
But didn't they lap some costs from last year?
They did. They had some reorganization costs last year that didn't repeat, but International and Sam's still saw deleverage because of planned wage investments. And Walmart U.S. deleveraged mainly because of higher depreciation and the operating costs from Vizio.
Got it. They also mentioned something about casualty claims.
Yeah, higher than expected expense there, apparently following industry trends. They expect that to stick around for a few more quarters.
Okay. But despite those pressures, adjusted operating income was still up 3% constant currency.
Right. And adjusted EPS, earnings per share, was 61 cents. That was higher than their guidance range.
So, summing up the quarter operationally, pretty solid, good growth, hitting that e-commerce profit milestone, strengthening with ads and membership. But then there's the tariff challenge.
Yeah, management called that the immediate challenge. They acknowledged some recent progress on trade policy, hoping for lower tariffs eventually.
But the reality is, even at reduced levels, the tariffs are too big to just absorb, right? Given retail margins.
Exactly. They were clear. It means higher prices for customers on those specific items impacted.
So how are they tackling it?
It's a multi-pronged approach. First, trying to keep food and consumables prices low, absorbing costs there where they can. Flowers was an example they gave of absorbing costs.
They're also moving production, sourcing where possible.
Yeah, but they stressed that's been an ongoing effort for years, not just a reaction now.
Trying to manage the impact across categories, not just item by item.
Right, absorbing costs within a whole category where possible, managing the mix of what they sell across items, categories, even across their different businesses.
And suppliers are adapting too, like shifting materials.
Yeah, the example given was shifting from tariff-hit aluminum to fiberglass. Plus, leveraging those growing high-margin businesses' ads, membership gives them a bit more financial room to absorb costs elsewhere.
What helps them navigate this?
Well, having inventory in good shape helps. Also, the fact that over 2/3 of what they sell in the U.S. is actually made, assembled, or grown domestically, and that percentage is growing.
They highlighted their U.S. sourcing commitment too, didn't they?
Big time. $296 billion spent last year, aiming for another $350 billion incrementally over 10 years, supporting U.S. small businesses through things like Grow With Us and their open call events.
But imports are still significant. Which markets matter most besides the U.S.?
China, Mexico, Vietnam, India, Canada were mentioned. China is particularly important for things like electronics and toys, so tariffs from China have the biggest impact.
And the timing. When did this really start hitting their costs?
Late April, accelerated in May. They expect it to play through the year, especially for imported seasonal goods.
Which makes planning tough, right? Forecasting demand when prices might go up.
Exactly. Hard to know how customers will react, how price sensitive they'll be. Makes managing quantities tricky.
Okay, so looking forward guidance. They still feel good about the long term.
Yeah, reiterated their long-term framework, grow sales around 4% annually, operating income faster than sales. And they expect to gain share, especially when things are uncertain.
And they think they can hit their full year guidance for this year, FY26.
Yes, but with a significant caveat. They can hit the guidance in their most likely scenarios, which assume trade policy moves towards agreements that lead to lower tariffs than the really high ones proposed. Back in early April, they mentioned 145% on some China goods.
But if those super high tariffs come back or elevated ones stick around longer,
then they warned it could jeopardize year-over-year earnings growth. It's a big if.
Okay, this leads to something really interesting they said about Q2 guidance. They didn't give an operating income range?
Right, which is unusual. Why not?
Several reasons given. The environment is just highly fluid. The potential price hikes from tariffs are extreme in level and speed. They need flexibility to play offense. And crucially, the potential impact from their inventory accounting methods, RIM and LIFO, is significant.
Okay, let's break that down. RIM and LIFO accounting. How does that create volatility with tariffs?
So RIM retail inventory method is used for most of Walmart US. When costs shoot up quickly because tariffs hit new inventory, the way RIM works can actually inflate reported margins on paper in that quarter. It's an accounting markup.
Even if they don't sell it at that higher price.
Potentially, yeah. If they later have to mark it down, that markdown hits a later quarter, offsetting the initial paper gain. Management used the word unprecedented to describe how big these quarterly swings could be because of this.
And LIFO, last in, first out.
That can also create charges when prices rise fast. Sam's Club saw that during the inflationary period in FY24.
So the timing of tariff costs, hitting inventory, flowing through these accounting systems, could make quarterly earnings look, well, jumpy, even if the underlying business is steadier year over year.
Exactly. That's the message. Think about Q2, Q3, Q4 together. Q2 might see big paper gains from markups due to RIM, which could then be offset by markdowns later on. It's about the accounting mechanics in this volatile cost situation.
They did give Q2 sales guidance, though.
Yes, 3.5% to 4.5% growth in constant currency. They noted about a 120 basis point headwind from currency on reported sales and said the mix between price increases and unit volume might look different.
So the guidance takeaway is confident in the full year if tariffs don't get worse, but expect potentially wild quarterly swings in reported profit due to these accounting effects interacting with tariffs.
Pretty much. Upside of trade news is good. Downside if tariffs stay high or go higher. They said they'll know more in a couple of months.
Okay. What about spending? Capital allocation?
CapEx spending on stores, remodels, tech, automation, expected around 3 to 3.5% of sales this year. Probably towards the higher end of that. And that spending level grows as revenue grows.
Yeah, and focused on driving returns, especially through automation. They said they're always fighting for the highest return.
And share buybacks. They were active there.
Very active. Repurchased $4.6 billion in Q1 alone. That's more than they bought back in all of fiscal 2025.
Wow. Why so aggressive?
They said they saw significant price dislocation in the stock and had strong conviction in their strategy. They expect to spend more on buybacks this year than last, staying opportunistic.
And they also raised some debt.
Yep, $4 billion in debt issued in April at good rates. So they're balancing buybacks, dividend increases, and investing back in the business. So looking ahead, what's the overarching message from management?
Strategy's clear, sales momentum is strong. They feel they're using their strengths to protect margins while growing.
And leaning into uncertainty.
Yeah, they believe history shows that's when strong companies emerge even stronger. They expect the same this time. Key themes continue. Drive e-commerce, 20% growth. Strengthen the model with ads, 50% growth. And membership, 15% growth.
And managing tariffs is key, but the goal remains keeping prices low while executing the strategy and growing profit faster than sales long term.
Right. So for you listening, what does it all boil down to? Walmart had a solid quarter. Growth came from selling more stuff, not just higher prices. Huge step with e-commerce profits. And those other income streams like ads and membership are really building strength.
But the big near-term issue is tariffs. Management is confident about the full year if things don't get worse on the trade front, but, and this is key, they specifically warned you about potential big swings in the quarterly reported earnings coming up.
Yeah, and that potential choppiness isn't necessarily about the core business suddenly going bad quarter to quarter. It's more about how these tariff cost changes ripple through their inventory accounting, RIM and LIFO. It can create temporary paper gains or losses that might look odd compared to the overall trend. Really highlights that mix of external pressures, how they execute internally, and even just accounting timing.
Okay, now for our segment. This is not financial advice.
And we mean it. This is absolutely not financial advice. It's just kicking around some ideas based only on what management said in this one earnings call. Always do your own research.
Right. So management spent a lot of time talking about the potential for unprecedented quarterly swings because of RIM accounting and tariff timing. They even withheld Q2 profit guidance because of it. That explicit warning itself is interesting.
Purely as a thought experiment, building only on what they said. Could there be potential for market overreaction either way to the next couple of quarterly earnings reports because of this known volatility driver?
The rationale, again, just from the transcript, is that Q2 earnings might look artificially high on paper because of those RIM inventory markups from tariff costs hitting, even if markdowns follow later. Management flagged this timing and accounting impact themselves, separate from the full year operational view.
So hypothetically, and we stress hypothetically, not as a recommendation, Could someone see this specific commentary as pointing to a potential short-term inefficiency? Maybe unusual price movement around earnings dates driven by these accounting factors that management highlighted, rather than just the core business fundamentals for that quarter.
It's an idea that comes directly from them, highlighting the accounting mechanics as a major, potentially unprecedented driver of quarterly reported results in this environment.
Again, just an idea spun from their specific commentary on the call. Definitely not financial advice.
Okay, so to wrap it all up, Walmart's Q1 was solid, volume-driven growth. Big milestone with e-com profitability. Ads and membership strengthening the business model. They're managing the tariff challenge, but warned clearly about potential big quarterly profit swings due to cost timing and accounting like RIM and LIFO. Still confident in the full year, assuming tariffs don't escalate significantly.
And remember, everything we discussed today was based solely on the information shared during that specific earnings call.
Thanks for joining us for this deep dive into the Walmart Q1 FY26 earnings call.
Yeah, we encourage you to keep exploring these topics, and as always, do your own research.